Good evening, everyone. Hope you are doing well. Yes, good evening, Rajveer, Soumya, Chavhan, Astha, Almas. Very good evening to one and all. Yes, Vishal, Shalini, Priya. So first query from Astha, sir, if the value ascertained by valuation officer is more. I'll come to that, beta. I'm adding points step by step because if I add too many things at the go, maybe things may get confusing. I'll explain that, but I'm yet to cover that. Yes, good evening, Harshada, Harsh. Sir, I have a question in residential status going outside for employment purpose. Sir, here we include both one who is going in search of employment. Yes, I also understand so. So when it says for the purposes of employment, I believe it is, see, when you say search of employment, it will be a short period because you are not having work visa till then. So you'll be coming back soon. So you have gone out for that particular search of work and you have got the work. This is what is the assumption. Just a minute. Yes. Yes, Rajveer. I'll be dealing with the provisions again. Yes, Janvi, Nessie. So, Asta, I hope I've answered you. Priya, I'll be on that today. So, students, let me now take you to the technical part of our PGBP. We have done that from my notes, which were designed to suit your comfort. Now we understand the provisions in the lawman's language. Now, in my second session, I had discussed with this particular format what to add, what to less. It is derived from your what you say, the provisions of PGBP. Now, in this particular format, after you have derived your PGP income, you all know that there are two schemes today of computing tax, the old scheme and the new scheme, which is now the default scheme. Now, when you are in the new scheme, there are certain expenses which are not allowed as deduction. And when you are in old scheme, there are certain expenses which are allowed as deduction, which are not allowed in the new scheme. Now, this is where we have to understand the difference in each chapter. Now, here, our module has beautifully given us one more format. What is this format dealing with? Pro forma for computation of income under the head PGBP under the optional scheme. Optional scheme means the old scheme. Now, as I said, if you look from the point of view of old scheme, you will find that there are some more deductions in old scheme as compared to the new scheme. So when we are computing PGBP income, the difference between the old and new have to be adjusted many times. Why? Because you are asked both these schemes. Now, what is the difference? If you have computed income as per the new scheme and you want to find out the income as per the old scheme, definitely the income would be lesser because the old scheme has some more deductions. Now, what are these deductions which are there in the old scheme but not in the new scheme? So what it is saying, profits and gains as per 115 BSC, which is the new scheme. From that, you will deduct what? you will deduct the expenses allowable under section 32 dealing with additional depreciation. Now, what is all this additional depreciation that we are going to discuss very soon when we go to the details of the topic of depreciation? So this is that additional depreciation which is provided over here in the old scheme. So what it is given? An assessee carrying on specified business and exercising the option to shift out of the default, that is shift out of the new scheme, that is you are converting into the old scheme, is eligible for deduction under 35AD in respect of capital expenditure incurred for such business subject to fulfillment of certain conditions. So you are also allowed the deduction of capital expenditure. So see, I think this is much better understanding of what is allowed in the old scheme, what is not allowed in the new scheme. So I think from here, we should be able to have a overview. But what I'm trying to explain you from this format is you first compute your PGP income as per the new scheme because it is now, which is the default scheme. So generally it is the one which is asked for. And if you're also asked to compute the deduction under the old scheme or the PGP income under the old scheme, simply take this profit as per the new scheme and from that deduct those additional deductions which are allowed in the old scheme. Now, what are those additional deductions? We can quickly go through from here. So what it is given under the default regime under section 115AB, allowability of deduction, treatment while computing income under the head PGBP, if debited to P&L, if given as additional information, and under the optional regime as per the normal provisions, that is the old scheme, allowability of deduction, treatment while computing PGBP income, etc. Now, first item is in-house research, scientific research, which is related to assessee's business. Revenue expenditure is allowable under both schemes, old and new. Any capital expenditure except land is also allowed as deduction under both the scheme. So as far as scientific research expenses in-house is concerned, both schemes allow you deduction for capital and revenue. But what is the difference? When you are talking about payment to outsiders, if you remember, this is that payment where even if it is not related to your business, you still get the deduction. So we are talking about payment made to outside approved organization. As you can see, it is to notified approved research association or company or some university, college, etc., etc. It is not allowed under the new scheme. Now, this is what is the point that you have to keep in mind, that the first difference between the old and the new scheme is with respect to scientific research expenses, but only, not all scientific, only the payment which is made to outside approved organizations. So it is allowed under the old scheme. It is not allowed under the new scheme. Fine. Now, today we are going to cover majority part of your PGBP from the module so that even the module gets covered. And today we are also going to go to much finer detailings of some of the sections which are already covered, but which are very in-depth. So let me start with the first part, some theory part. Now, what is covered under this head is income arising from business or profession. Now, it is very important to understand when a particular activity is business and when it is not business. Because if it is not business, then other heads will apply like HP, like other sources. But if it is business, then you will be covering it under the head PGBP. Right? So let's see what are the details. Now, what is covered under this head is business or profession. Now, interestingly, business has been defined to include trade, commerce, manufacture. We all know the meaning of this. What is interesting for me is this: any adventure or concern in the nature of trade, commerce, manufacture. Now, what is the difference or what is this point? Let us understand. The point is, generally it is presumed, generally it is assumed that something which you do on regular basis is only what is business. However, the definition over here and even in GST, when you'll study that, in both places, they have clarified in the definition itself that even a one-time activity, which may not be done with regularity, which may not be done consistently, can also be business if it is in the nature of trade, commerce, or manufacture. So example is, I'll give you a simplest example. We will have very soon Raksha Bandhan. We will have very soon Ganpati festival. Sorry. Now in all these cases, many people puts up stalls for selling Rakhi, stalls for selling kites during the kite festival, and many times they put up these stalls for selling Ganpati idols, Durga idol at the time of respective functions. Now, these stall owners are not into regular business. Many times people just do it for one season. They may not repeat even in the next season. But for that one season also, where they have done that trading activity or commerce activity, it would be classified as business. What is profession? See, profession is something which requires expertise, which requires some degree of learning. So when you are engaged in any such activity where some degree of learning, some degree of expertise is required, that is what is profession. For example, even the work of painter, sculptor, author, doctors, lawyers, all your beauticians, all these come under the category of profession. Now, there is, I think, a misunderstanding that many times people believe that profession is only that where it is having some qualification or degree. That is not compulsory. Even in the definition, you'll say it may be on the basis of some degree or it may be on the basis of some learning or training, like painter, like sculptor. These may not be having any qualification as such, but still they are considered as professionals and engage in profession. Yes, Dhanush, I'm coming to that. Because they say profession also includes vocation. Now, what is vocation? Understand one thing. Vocation is where your profession is also your lifestyle. I repeat. So, what you are professing, you are also living. Example, people who are involved in religious activities, like we say saints, like we say people who are doing performing all these pujas and yagnis, that is all the panditjis, the mahants who perform all these pujas at our places, and we pay them their dakshina or the fees. Now, when these people are doing these pujas and all, firstly, they are engaged in profession. Agreed? Because it requires a lot of learning. In fact, many of these have qualifications. But it is more specifically a vocation. Why? Because if you observe their entire lifestyle, including their clothing, including their appearance, including their day-to-day activity, their in fact daily routine is linked to their work. So when they are into a particular work and their lifestyle is attached to that, their entire lifestyle is designed or is means they live like that particular profession only. That is where it is called as a vocation. Like we are chartered accountants, we are not living in a very specialized manner how chartered accountants live, because chartered accountants live like any other person. But when you look at any saint or any particular person who is involved or engaged in religious performances, that person's lifestyle, in fact, everything, even in his house, will be very much aligned to the professional work. That is what is vocation. Now, there are some interesting aspects about business. This was the first point which was raised in the first session. I don't remember the name who had raised this point, that what if I receive my business income in kind, whether it will still be business income? Yes. So it is not only business, any head income, whether received in money form or in kind form, makes no difference. So far as it is income and it falls in a particular head, you have to cover it in that head, even though you may have received it in non-monetary form. Generally, capital receipts will not come under this head, but again, there are exceptions. Certain specified capital receipts, which are specified in the definition, will fall in this head. Other than that, will not fall in this particular. Then comes an interesting point, voluntary receipts. Now, what are voluntary receipts? Voluntary receipts are something for which there was no contract, there was no prior commitment, but you receive that. Now, the interesting point is where such voluntary receipts are arising from your business or profession, that will also be covered. But where it has no connection, anything with your business or profession, it will not be covered. I'll give you a very, very simple example. You are a professional. You are fighting a case like a lawyer for your client, for which you have quoted the fees of rupees 5 lakhs. The client has paid that. But the matter was very sensitive. It was concerning the life death of the particular person. And because of your skill set and because of your professional acumen, you win that case for the client. Out of that particular feeling of gratitude, the client gives you an Audi car. Now, in this particular case, the Audi car which the client gives you, you will say that he has gifted. So it is a voluntary payment by the client. So it is a voluntary receipt for you. Whether there will be any tax, they are saying yes. In fact, when we read section 28, they have specifically included such types of gifts or voluntary receipts which are arising from your business or profession. So that connection has to be there. But what is
Sir,
your first name?
Tej.
Sorry?
Tej.
Tej. Yes, Tej. Please tell me.
But sir, gifts are covering other sources. No?
That is better what is I'm trying to emphasize on. Gifts in other sources chapter is only when the gifts are received from unrelated persons, and most importantly, those gifts are not having connection with your business. As I gave you example, if any gift or if any benefit arises in relation to your business or profession, like I'll give you another example. One example I gave you of profession, another example I'll give you of business. Now you are having agency of some branded company, let us say Britannia. You are the distributor. Now, if you achieve a particular target, the Britannia company says, okay, wow, you have achieved this target, 100 crore target in this year. Chalo, I'll give you a foreign trip for you and your family. Now, this is a type of a benefit which may not be contracted or which may not be agreed upon. But since you achieved some great feat, recognizing your extra efforts, recognizing your special hard work, the company is giving you, besides whatever commission margin it is giving you, it is giving you a foreign trip. Now, this foreign trip which the company gives you is again your PGBP income. It is a voluntary receipt. You call it as gift, you call it as perquisite, you call it as benefit, you call it by whatever name. Most important thing, if it is having a connection with your business, it shall fall in the business head.
So sir, anything connected with business is come under PGP.
Yeah, anything connected with business, satisfying the conditions of business or profession, not capital in nature, will fall under business. In fact, if you remember, I started with that point only, that first understand what is business and profession, because what will not be business and profession can then be classified in house property or in other sources or in capital gains. But if it is something is business, it will fall here only. I mentioned this at the start when we started understanding or discussing business profession definition, right?
Understood. Thank you, sir.
So don't be carried away by the words used, like, for example, we are saying that interest comes under the head other sources. Agreed. But if I'm in the business of giving loans, like I'm a bank is earning interest. Where will it be shown in the income tax returns of the bank? Obviously, in the PGBP head only. But when you and me are getting interest, for us that interest will come under which head? Other sources. Similarly, for the gift point. Is this clear to all?
Yes, sir.
So don't be having a very rigid understanding that all gifts will be covered in other sources only. It depends upon whether it has a business element. Ishan is asking, so sir, even if received a flat or land from a client, would it be PGPP? Yes, why not? If, let us say, I am providing services to my client, and since the quantum of my service is very high, the client comes and says, "Ki Vishal, right now I'm not having that much money, but I have this particular plot or I have this particular flat, which is somewhere equivalent to your fees amount. So I'll do one thing, I'll transfer this flat or this piece of land in your name. Will it not be my business receipt?" Answer is yes. That was the point above, whether it may be in cash or it may be in kind. So whether you are receiving it in the form of flat or land, what difference it makes? Sir, they are capital item, rights. Please, Dhanush beta, please understand. They are capital item means what? What is not covered under PGBP head is where the receipt is a capital receipt. When I am receiving my professional fees, it is a revenue receipt. Only the form in which you are paying that money is maybe in money form or it may be in kind form. That kind may be a capital asset. It makes no difference. Tomorrow, when I sell that land, that will be my capital gain income. Today, when I'm receiving the land or flat, it is not a capital income. It may be a capital item, but what I'm receiving is my fees, and fees is my revenue income, and it is not my capital income. I hope this differentiation is clear. Sir, income from professionals also come under PGBP. Yes, beta, the name itself is profits from business and profession. Like you said, lawyers, client gave audit. So that comes under voluntary receipts. Yes. I did not get Priya, what is your doubt in this? So I've been explaining right from start that business, profession, both are covered under this head. So income of businessmen and income of professional, both get covered. I in fact gave you example of lawyer only. Fine. Next, application of gains to trade is immaterial. So how you are using that money in business is immaterial. What is important is that when you are earning, the earning has to be arising out of business profession. How you use the money in business makes no difference. Income distinct from business, it simply means that it is not necessary that you will have one type of business only. You can have multiple businesses and all business will be considered as a separate business. You will compute the income from each business separately. Then you'll add up all the incomes from all the businesses and profession and it will become the total of PGBP head. But computation wise, it will be done head wise. Computation of profit. Profit should be computed after deducting the expenses and losses, which we have been discussing. Interesting, legality means what? What if you are engaged in some illegal business? The question is whether you have to pay income tax on some income which you are deriving from illegal activities, illegal businesses. See what is given. Income tax is not restricted in its application to lawful business only. Means tomorrow if you are engaged in some unlawful business, still if you are earning income from that unlawful business, you have to pay tax. So Income Tax Act is not making any distinction between lawful or unlawful business. But yes, expenses incurred by an assessee for any purpose which is unlawful offense will not be allowed as deduction. This is what is the restriction. So where your expense is for any unlawful activity, there will be no deduction. Dhanush is saying, sir, give example. But my business is, let us say, I am involved in all types of black marketing activities. Now, black marketing of goods or etc. is unlawful. But if that is how I'm doing my business, or I'm dealing in some illegal activities like drugs and all, still what I'm doing is trade commerce. So all these are examples of illegal business. I still have to pay tax. Fine. Then this point we have already discussed again at the start. Okay, I have a question. So, sir, if any person earns money from theft, haha, he has to pay tax, then his money is legal. Please understand one thing. See, we are understanding the concepts of taxation. Now, taxation says we are not concerned with the manner in which you have earned the income. Even if it is unlawful, you are supposed to pay tax. Point number one. Point number two. Now, you are saying, see, sir, if someone is doing kidnapping, someone is doing theft, whether they will be paying the tax. Now see, whether they pay the tax or not, that is their personal choice. And obviously nobody practically who is doing an illegal business will show in their income tax returns that their income is from illegal source. So practically they will not be showing that income. Yes, but let us say tomorrow there is any raid and they are caught and it is identified how they have earned income. They cannot take a plea. Since I was doing something which is illegal, I don't have to pay tax. That is where this point comes into play, that they will also be leviable to tax. Next, method of accounting. If you remember, I discussed this, that both these heads, PGBP and other sources, for this, you are given the option that either you may follow the cash basis or the mercantile basis, whatever you are following regularly for your accounting. So whatever you are following regularly in accounting, the same method would apply over here for computation of PGBP and other sources. However, see, every rule has an exception. So even this rule has created some exceptions whereby some incomes will be taxed only on one basis, either cash or either mercantile. But those are exceptional cases. Other than that, all other incomes falling under PGBP and other sources, you can choose between the methods. Now, what are those incomes for which option of method is not allowed and only one method is to be followed? Interest received by an assessee on compensation or enhanced compensation. This you will study firstly related to capital gain, that when your property is compulsorily taken over by government because the government wants to construct some road or they want to have a track for bullet train. So your land is compulsorily acquired. So government has to give compensation. Many times this compensation given is late. So they have to pay interest. Now this interest which you receive on this compensation will go to the head other sources. For this interest, the rule is it will be taxed only on cash basis, not on due basis, or there you do not have the option. Similarly, the second item which is covered over here in the exception is, this is now related to business, where you get any type of government benefit. Now, these are all export related benefits like duty drawback or cash assistance or some type of subsidy, etc. Again, this will be taxed only in the year in which it is actually received and not on due basis. So for these two incomes, they have mentioned or they have clarified that you have to compulsorily follow the receipt method. Other than these two incomes, for all other incomes falling under business head or other sources, you are given the choice. Now, interestingly, similar to accounts, we have standards here. Now in accounts, we have accounting standards. In income tax, we have ICDS. What is the full form of ICDS? ICDS stands for Income Computation and Disclosure Standards. So there are certain standards specified by which you have to compute the income and you also have to disclose the income in income tax. These standards are called as ICDS. These standards are presently 10. So there are 10 ICDS which are provided. However, these ICDS you will be studying in detail at the final level. As of now, you understand whatever we are studying in PGBP other sources, they are following the ICDS only. Sir, section 24 above will come under which head? Okay. There is a question. Is sir, section 2 bracket 24 will come under which head? Please understand section 2 bracket 24. I think you are referring to this. 2 bracket 24 is the section which defines income. So section 2 clause 24 of the Income Tax Act is defining income. It is not pertaining to any head. It defines what all things will be covered in income. And then every head will define that out of this is covered in my head, this is covered in my head, this is covered in my head. Sorry. So in the definition of income, so income definition is section 2 clause 24, and then you have this sub clause which is sub clause 18, that is Roman 18 is written. In this they have mentioned about which income, all types of export benefits. So 224 is defining or it is giving you a list of incomes. Now every head will tell you these incomes fall under my head, these incomes fall under my head. So when we'll study PGBP section 28, which is the charging section of PGBP, because it is the first section of the PGBP head, you'll find the reference of this income there. So section 28, which is the charging section of PGBP, says that this income will fall under PGBP. But 224 is the section defining what all things are incomes. Fine. So now this is section 28. It defines what all things or what all incomes would be taxable under the head PGBP. So first, generic rule what 28 says, that income should be arising from business or profession. So for anything to be taxed under this head, the first condition is it should be having a business or profession connection. Now some special points where they have defined what all things would be specifically covered here. First is the compensation. Now, what is this compensation for? Please understand, compensation is like a one-time payment. And when compensation is given, when there is some loss to you, when there is some sort of, what I can say, something of yours is taken away. So I have to compensate you. Now, the interesting question is, where will this compensation fall? Again, please pay attention. If your capital asset is taken away and you are given a compensation for that, like I was explaining above, your land is taken away compulsorily by the government, so they pay you compensation. Since it is a compensation against your capital asset, it will fall under the head capital gain. We are going to now study what will fall under section 28, thereby meaning that what type of compensations would come under PGBP. So first compensation is compensation which is given to you in connection with termination of the management or office. Now it sounds difficult, but I'll explain you what it is. It simply means that you were managing the whole of this power of management is terminated. Now you are no more going to manage this. It will be taken over by someone. So when they are taking over your managing powers, as good as your power to control the company, run the company, whatever compensation paid to you will come under this particular section 28. Now please understand, here you are given compensation for giving away your managing rights. It is not for giving away the assets. If any assets are taken over and you are given compensation for that, it will always go to capital gains. Second, you are holding some agency and I tell you that, okay, now this agency has to be terminated. So for terminating this agency, I am giving compensation. Again, agency was your business. So when your agency is terminated, whatever compensation I give you for terminating the agency, that is what is again covered in this particular head. Next. Just 1 minute, please, students. Okay. Now, third is what? Third is you are given compensation in connection with vesting in the government. What vesting in the government? The rights of management of any property or business. Now, this is nothing but nationalization. As you know, that there was a time when many of these sectors were under the private control. Later on, during, if I'm not wrong, the Indira Gandhi regime, many of these were nationalized, like the banks were nationalized, airlines were nationalized. So what they did was that even though you are managing that particular business or property, that was taken under the control of government because of nationalization policy, and you were given some compensation. That is also what is covered over here. And last is again compensation, which is in connection with terminating or modifying what? Terms and conditions of any contract relating to business. If you find that in all these four, there is again the presence of the element of business or management of business. So whenever you are managing a business, you are having that managerial position, and I ask you to terminate that, and for that termination, I'm giving you compensation. That is what is covered here. Yes, beta Anubhav, we are talking about the compensation which will come under the head PGBP only. We are reading section 28. So whatever compensations are mentioned here are all PGBP compensations. Fine. Okay. Now, next comes income from specific services performed for its members by trade, professional, or business bodies. So the best example of this is ICAI. ICAI is a professional body providing services to its members. So whatever fees the ICAI charges to the members, that is to us, not to y'all, that is what is PGBP income for ICAI as per section 28. So whatever income ICAI earns from the services performed for its members, that will be treated as PGBP only. Then comes this point, incentive is received or receivable by assessee carrying on export business. So this is what we read above also, section 224 covered this. So all these benefits which are arising to an exporter as a part of any export benefit given by the government will come under the head PGBP only. Now, this is that point. That is where some voluntary payment is received, where some gift is received. So where any type of benefit or perquisite which is arising from business or profession. So it may be a benefit perquisite which is arising from business profession, again convertible into money or not, again in cash or kind, whatever, it shall come under the head PGBP. So here all types of gifts, voluntary payments, etc. would get covered. Then as a partner, whatever you get from your firm, whether you call it as salary, whether you call it as interest on capital, everything will be covered under the head business. So as partner, when you get salary also from your firm, it is not part of salary head, it is part of PGBP income only. So a partner deriving interest on capital, a partner getting remuneration, salary, bonus, commission, whatever a partner gets from the firm is always covered under the head PGBP. Now relating to this, we will study a condition, a restriction under 40 clause B, because there are some limits provided subject to which a firm will get deduction. So for partner, whatever it is receiving is income. So in the hands of the firm, whatever it is paying is also expense. But there is a restriction on quantum of expense which the firm can claim. So firm cannot pay you any amount of remuneration. Firm cannot pay you any amount of interest. Cannot means it can pay you, but income taxes, we will not consider every amount as their expense. So that is what is provided under section 40 clause B. Now in this regard, you have to remember one thing, that firm pays three things to its partners. One is interest, one is remuneration or salary, and the last is share in the profits of the firm. Now out of these three things, the share in the profit which the firm is paying to the partner is exempt in the hands of the partner. So the share in profit is the only item which will not be taxable in the hands of the partner. Why? Because the tax on that net profit is paid by the firm itself. So whatever is the final net profit of the firm pays tax. Hence, in your hands, when the profit is divided in the PSR and you get your share of profit, it will not be taxed. Otherwise, it will be double taxation. Next. Now, this is again an interesting point. We call it as the non-compete piece. What is non-compete piece? I am doing a particular type of business or profession. You wish to start the same type of business or profession in my area. Now, if I do not want that we compete with each other because it will adversely affect each other's business, we may enter into a contract whereby I will say that, okay, I will pay you a particular amount. Against that, you will not do a particular activity in a particular area. So you agree not to carry out certain activity relating to business or profession. That is what is today called as non-compete piece. Similarly, if you are having a particular knowledge, you will not share that particular knowledge, patent, copyright, trademark, license with others. Because if you share it with others, again, it may affect my business because I am also using the same type of copyright, trademark, franchisee. Example, you are McDonald's. Now, you want to start your franchise in Nashik. I say, okay, fine. I'm taking your franchisee, but with a condition that you will not give anybody else the same franchisee, at least in Nashik. You say, okay, I'll do that, but for that, I will charge you 5 lakh rupees because they could have given franchise in different parts of Nashik and they would have earned more. But I am putting this condition that you do not share your franchisee with anybody else in Nashik at least. So if I am taking franchisee, you cannot share it with others. This is where whatever fees I will pay to you for not sharing your franchisee rights with others will also be treated as your business income. Then comes amount which is received under a key man insurance policy. Now, what is a key man insurance? See, key man, the name itself suggests he or she is the key person of your business. This person is such that without this person, maybe your business may come to a standstill or it may be closed down completely. Now, that person may be your director, that person may be your partner, any person may be a key man, even any of your special employees. Now, there is a special provision in the insurance companies that now see, normally we take a life policy, but that is generally coming in a personal category. When we take a life policy for ourselves or our family members, it is a personal expense. Income tax does not give you deduction for that under the head PGBP. But if as a businessman, I take a keyman insurance policy, which is also life policy, but I'm taking it on the life of that person who is most important to my business. Without that person, my business may suffer a big loss or it may even close down. Such a person is the key person to my business. Now, when I take a policy for such a person, in the name of such a person, it is called as a key man insurance policy. Point number one. Point number two. This particular policy, whatever I am making payment of premium, since it is a business related policy, I get deduction under section 36(1). We are going to study that today. So there is a section 36(1) which gives you a list of many expenses for which deduction is allowed. One of them is premium for keyman insurance. Sorry, not 36(1). This premium is covered in 37(1). Now, when this policy amount is received, at that time, what will be the tax treatment? Now, the tax treatment of the policy amount received under keyman insurance policy, first is it is taxable. If you receive a life insurance policy amount, in general, it is exempt under section 10 bracket 10D. So there is an exemption if you are receiving a normal life insurance policy amount. Obviously, there are some conditions over there, but if you are receiving a keyman insurance policy amount, it is always taxable because it is not covered under the exemption of section 10 bracket 10D. Important. It is taxable under which head? Now, there are three possibilities. One, this keyman insurance policy amount is given to the employee because employee was the key person and the policy was taken in the name of the employee with the benefit going to the employee. So if the keyman insurance policy payment goes to the employee, it is taxed to the employee under the head salary. Second, because of the death of the employee or the key person, the business gets the keyman insurance policy because the business is the one who is going to suffer loss because of death of that person. So if the business is getting the policy amount, business is taxed under the head PG. Third, if the family member of the deceased person get the policy amount, So if let us say because of the death of the employee, the policy amount is given to the family members of the employee. In that case, it will be taxed in the hands of the family members under the head other sources. So there are three heads under which it will get taxed depending upon who is receiving. Employee himself herself receives salary head. Business receives PGBP head. Family members of the person receives other sources. Now, what is this point? You are having something which is stock in trade. You are now changing the status, and now you will say that this stock in trade is my capital asset. So what is appearing as stock in trade till date, now you show it as a fixed asset in your books. This is called as conversion of stock in trade into capital asset. Interestingly, the law says when you convert this, that is, you simply change the category from current assets to fixed assets, and you start treating it as your long-term asset in the form of building or land, that will also be treated as business income. And for this, the value to be taken is on the date of your conversion, whatever is a fair market value, that will be considered as your PGBP income. Then there is one more point. This deals with that section 35AD. If you remember 35AD is those specialized businesses. We will discuss 35AD at that time. I'll come to this point because right now, if I'll explain this point, it will not make much sense. When I'm explaining 35AD, I'll explain you this point of section 28. So students, these are the different elements which are covered under the head PGBP by virtue of section 28. So as per 28, these are the different items which, since are arising directly or indirectly from business, will fall under the head PGBP. Anybody? Any questions? Yes. First question, as a student, sir, do we have to learn this? Answer is yes and no, both. No, because today they will not ask you to write this as a theory question. Yes, because it will be required by you for indirectly answering some question, which may be an MCQ question. At that time, you may have to select out of these four what is not covered in 28 or what is covered in 28. That is where you need to remember it. So I will say you remember it. At least you should know what is covered in 28, what is not covered, right? But you don't have to learn it verbatim because they will not ask you to write it. Is this clear? Now, there is another point, or the next heading that you can see is speculation business. Students, I know you may have some small doubts here and there. Let me go ahead with the discussion. Maybe towards the end of today's session or in the next session, I will come back to the point because many times it happens that talking a lot on one point may not be very helpful in that time. Let it just pass on today. Let you just have a feel like somebody's asking, sir, what is schema? And please explain. What is point number 9? Please explain. See, I will request that you all just be patient. If you find that in previous 3 lectures, I repeated the points again and again, that I will do again even for these points. So let me just go ahead with these points today. I will come back in the next session for the minute pointers. Till then, you also just read through it. Maybe you will get the answers. If not, I'll answer it in the next session. Okay. Coming to speculation business. Now, interestingly, first misunderstanding about speculation business is the stock market is speculation business. Generally, if anybody asks you what is speculation, you'll say stock market. Please understand, student, this is a very raw answer, and I will say to a great extent, it is also an incorrect answer. Stock market completely is not speculation. First thing. Second thing, if you are selling and buying real shares, it will always be either your PGBP, if that is your business. If not, it will be your capital gains. But even if it is PGBP, it will not be speculation if you are buying real shares. Now then somebody will ask me, sir, then what is not real shares? That is what is today called as derivatives. Then you have different types of instruments. You have call options, put options. All these are different instruments in the stock market where people do trading. but not of actual shares, but of these special instruments of stock market, which are generally called as derivatives. Now, what is speculation? Please understand, it is a misconception that share market is speculation, that you may call in your layman's language, but the taxation does not calls it so. What does the taxation then calls speculation as? Let me give you the definition. Speculative transactions mean a transaction in which there is a contract. Contract is for what? Contract is for purchase or sale of a commodity, which may also include stock or shares. So it may be either any commodity like gold, like silver, like wheat, like crude oil, or it may be shares. Now, what is most important about this contract? When this transaction is termed as speculation, when such a contract is periodically or ultimately settled. Settled means closed. But how it is settled? Without the actual delivery or transfer. Interestingly, so our transaction is dealing in commodities. It is a contract of purchase sale of commodities. It is a contract of purchase sale of shares, but it is settled, it is squared, it is knocked off not by actual physical purchase of these shares or of these commodities, but by simple book entry. What is this book entry? This is what is generally called as derivatives. Now, as we go ahead with this definition, you'll find that derivatives, which are now approved, are also removed from the speculative. So they have also become a regular transaction. But where it is not an approved derivatives, or where it is a transaction where there is no physical purchase or sale of commodities or shares, that is what is speculative. I'll give you a simple example. Let us say, considering the present strained relations, first is between India, Pakistan, second is between Ukraine, Russia, third is between US, China. So many different equations are going on. There is a buzz that gold prices are going to rise. I'm just giving an example. Now, I want to take the benefit of rise in price, but I do not want to purchase real gold. So what I do is, let us say I contract with one of you who believes otherwise. So let us say Bunny Preet feels कि नहीं नहीं सर, गोल्ड का प्राइस बढ़ेगा नहीं, ये रीजंस की वजह से गोल्ड का प्राइस तो गिरेगा. Everybody may have their own calculations, and I say no, the gold price is going to rise. So what we do is we enter into a contract whereby, let us say today's price of the gold is 90,000, for example, and I say it will go to 1,20,000. So I say, Bunnypreet, let us enter into a contract that today's price is 90,000. You book 1 kg gold in my name at today's price. So 90,000 is per tola. I am saying, okay, we enter into a contract whereby we book today's price as if I am purchasing this gold from you today at 90,000 per tola, and you book 1 kg in my name. So we are only booking, we are passing just an entry. So neither I am actually taking the gold, neither she is actually giving me the gold. And I say that we will square off, we will settle this transaction after 2 weeks, after 1 month, after 3 months, that is provided in the contract. And we will settle it at that day's price, whatever it is. Now, Bunnypreet is also okay with this contract because she's speculating that the prices are going to fall. I am speculating the prices are going to rise. So let us say the squaring of date is 1 month from today. So we come to 1 month from today, let us say end of May. And the price of gold has become 125 per tola. Now I will say, Bunnypreet, as per our contract, we will knock off this transaction. We will settle this transaction. Now what is settling? Okay, now I will show that I have sold that 1 kg gold to you, or you will show that you have purchased that 1 kg gold from me, but both are book entries. Today I did not actually purchase, neither you actually gave me the gold. We only made that book entry. Similarly, we knock off this book entry by passing an opposite book entry. So now I'm saying you show it as, I'm showing a sale to you at that day's price. Now, if that day's price is 125, my purchase was at 90, my sale is at 125, I'll say, Bunnypreet, now you pay me the difference. Vice versa. Had this fallen, Bunnypreet will ask me to pay the difference. So this is an example of a speculative transaction. I've given you a very crude example, a very raw example. But this is what this definition says, that there is a contract for purchase sale. So we had a contract of purchase sale of a commodity which is gold, and this transaction is ultimately settled, but without actually taking or giving the gold, only by passing the reverse book entry. In stock markets language, we call it as squaring off. So the transaction is squared off at that time's price. This type of a transaction where you show purchase sale of commodities, of shares, or of anything, but you actually do not buy or sell it. It means you're only showing the debt. Just visualize, it is a ledger account. I have opened Bunnypreet account. I have put one debit entry at today's price. I'll put a credit entry at the other price. The difference I'll ask Bunnypreet to pay me, or I will have to pay it to her. That is simply a speculative transactions. Let me tell you, speculative does not means illegal. Many times the second thought that comes, one is it is the stock market. Another thought that comes to people is speculative means illegal. Sorry, they are not talking about illegal. Please remember, beta, betting is not speculative transaction. It may be speculation. Betting is altogether different thing. Is it dealing with purchase sale of commodity? Answer is no. So that betting, gambling, all those are part of other sources. It is part of winnings. It cannot come in speculative transaction. It cannot come in PGBP, because over there is no contract for purchase or sale. Correct? So for it being classified as speculative transaction, for it being classified here under PGBP as a speculative transaction, it should have the element of contract of purchase or sale. Now, the second type of speculative transaction is made for companies. So if you're a company where your business is not, I repeat, your business is not purchasing, selling of shares. So it means you are in a regular business of manufacturing, or you are a service provider company, but you are not in the business of purchase sale of shares. Now, who is in the business of purchase sale of shares? Investment companies, banking companies. Their business requires purchasing, selling of shares. But your business is not purchasing, selling of shares. However, you have dealt with the shares of some other company. In that particular case, the law says when you are dealing with in the purchase or sale of shares of some other company, then you shall be deemed to be carrying on speculative business to the extent to which your business consists of purchase sale of shares of other company. In simple words, a company should not be dealing in shares of other companies until unless you are an investment company or a banking company where your business requires this. But where your business does not require this, you should not be dealing with in shares of other companies. But still, if you are dealing in the shares of other companies, we will treat your transaction of purchase sale of shares of other companies as speculation. So for companies, this one type of transaction is speculation. For everyone, this type of transaction of purchase sale, which is settled without actual physical delivery, is what is speculation. However, they have carved out certain exceptions where it will not be regarded as speculative transactions. So these are the exceptions where even if you do the above type of transaction, that is actually squaring off without actual purchase sale, still it will not be termed as speculative. One is where it is a hedging contract. Second, again, it is a hedging contract. It is a forward contract. It is a derivatives. Where it is a derivative, the eligible transaction should be carried out electronically through SEBI registered stockbrokers. As I said at the start, earlier derivatives was fully speculation. Now they have added this in exception where you are doing derivative transaction through a SEBI registered stockbroker. It will now not be considered as speculative. It will be considered as your regular business. Similarly, if you are doing trading in commodity derivatives, like I gave example of gold, that is a commodity derivative. Again, If you are doing eligible transaction which is carried out electronically through a member or intermediary which is registered under the bylaws, etc., etc., of a recognized stock exchange, it will not be considered as speculative. In short, now onwards, when you are doing all these transactions of derivatives and all, but not through recognized brokers and all, only then it is considered as speculative. Please remember, speculative does not mean illegal. Secondly, speculative. Now, these are all share related transactions, but the regular share market transactions are not considered as speculative. Even though it deals with fluctuation of price, that is not speculative. For speculative, the condition is there should be purchase sale without physically giving or taking that commodity or shares. That is only derivatives. And today now, eligible derivatives are no more speculation. They have been removed from the definition of speculation. So only those derivatives, only those transactions which are not through registered brokers, only they will now fall in speculative transactions. Yes, but the examples which I gave was commodity derivative only. Fine. Correct. Now, once we understand what is business, and now we have understood the business can be speculative or regular. Now, what is the difference between it being a speculative business or regular business? The difference you identify when you study set-off chapter. In set-off, they have said that if you are having a business loss, you have to first find out whether the business is speculative business or regular business. If it is a speculative business, like what we just studied, the treatment for setting off the loss and later on carrying forward the loss is different. So for speculative business, the conditions for carry forward and setting off the loss is different as compared to regular business. Other than that, for computing PGBP income, whether your business is speculative or regular makes no difference. Then comes section 29, the second section of this head. It says nothing. I repeat, it says nothing. Why am I saying it says nothing? Like 28 was speaking about what will be incomes. 30 onwards will be speaking about what are the expenses. 29 says nothing because it simply says for computing the PGBP income, you have to follow the sections 30 to 43D. Now that anyways, even if this section would not have said, I would have done the same thing. After 28, I would have gone to the next section and I would have applied all the sections. So that is why I'm saying technically, practically, this section is not saying anything very special. It simply says that you should compute the PGBP income in accordance with whatever is given in sections 30 onwards. Correct? Now, this is the brief overview of these sections 30 onwards. So 30 to 37 is covering all these sections, which gives you deduction. So basically the 4 golden rules, the exception to the golden rules are covered in 30 to 37 in different sections. Each section is covering different expense. Then we studied 40. We studied 40A. Both these are dealing with some type of restrictions where something is disallowed. So we studied many provisions of 40, clause A, etc. And we studied 40A subsection 1, subsection 2, subsection 3, 7, 9, etc. Then we also studied 41. What is 41 dealing with? 41 is also dealing with what is taxable under the head PGB. Remember what is 41 dealing with? Your past expenses losses for which you have already claimed deduction, then now that is recovered or reimbursed. That is covered in 41. And then you have some procedural sections. So you have some procedural section like maintenance of books, getting those books audited, then some special provisions for computing PGBP income on ad hoc basis. Those are the other provisions which are mainly covered in 44. So this is how your entire 30 onward sections is designed, where 30 to 43 is dealing with some or the other computation related provisions, and 44 is mainly the procedural part. Now, starting with the first category, 30 to 37. In this, firstly, section 30, it covers which expense? It covers expenses relating to building. except depreciation, because depreciation is covered in 32. Now, what are those expenses relating to building? Rent, rates, taxes, repairs, maintenance, insurance. So all expenses which you incur for the building, they are all covered. Now, when you read section 30, you will find out that indirectly or directly, they have given the four golden rules only. That the building should be used for business, the expenses should be of current year, the expenses should not be of capital nature, and it should not be an offense. So they have given you what are the different deductions that could be covered. In this, they are saying that deductions of rent, taxes, repairs, etc., of building used by the assessee for the purpose of his business. So here they have put in the condition that it should be related to your business or profession. Then it is saying that it should not be of capital nature. If it is of capital nature, we will not allow it. Then there is a very special scenario. What if the building is partly used in business and maybe partly personal? Like many times, people have a flat where the front part of the flat, which is the hall, is generally made into office, and they stay in the other rooms and they use the other rooms for their stay. So they have converted their flat, the front side, as office, and the remaining rooms are their personal rooms. Now, in such cases, how to claim this deduction? For this, there is section 38, which is applicable to all expenses. What it says, whenever you are using any asset partly in business and partly for your personal use, you have to proportionately take the expenses. So whatever proportion, maybe on area basis, is applicable to your business portion, you will claim it as deduction. What is pertaining to your personal portion, you will not claim it as deduction. Then you have this other section 31. Now 31 is dealing with expenses of repairs, insurance. Again, same expenses, but now for other assets other than building, like plant, machinery, furniture. So for plant, machinery, furniture, whatever expenses you incur on its renting, repairing, insurance, etc., is covered. Again, conditions are same. It should be used for the purpose of business. Again, it will not include any type of capital repairs or any type of capital expenses. That will not be covered. So if you look at these, you will find that the conditions are more or less revolving around the four general rules. Is this fine? Now we come to a very important section. Just give me 2 minutes break. So this section is requiring some calculations, and it is different from what you have studied in accounts. So that is where you have to be more attentive. There are some pointers in chat. Can future stock options be an example? Yes. It is a type of derivative. Yes. So the example you gave can be termed as derivative. Yes. Derivatives done from demat account included. Yes. Insurance premium paid of previous year in current year. Asta, but I think you had a similar question earlier also where you were asking me about what was your topic then? You had asked me, I think, you had asked me something. Arrears, I think you had asked. See, understand one thing. The rule is very simple. Only if it is arrears, I can allow you deduction in the current year. Otherwise, there is no deduction allowed for past year's expenses in the current year because that is our rule. So you cannot claim that deduction in any condition, right? Now, let us go back to our notes with the details of these sections. 35 AD we are dealing later. Right now we are in depreciation. Okay. Now students, please pay attention because what I'm going to explain you right now is something very different. You have studied depreciation in your accounting, but what we are going to study here is quite different. Now, income tax covers the deduction for depreciation under section 32, and it is also provided in rule 5. So we have income tax act where all sections are given. We have income tax rules where different rules are given. Mainly the procedural part is given in the rules. Now, when I talk about the section is further having some bifurcation. What is this? Section 32 subsection 1 deals with the deduction relating to depreciation, and 32 subsection 2 deals with carry forward and set off. This you study in the set off chapter. Now, when we talk about deduction, it has divided the assessees into two categories. One, those who are engaged in power generation. So all your electricity companies who are generating power are covered here. They are covered in clause 1. And all other businesses, all other except the electricity supply generating companies, they are all covered in clause 2. Now, why to distinguish between these two businesses? Because power units are given an option. What is the option? They can compute depreciation by the SLM method which you have studied. Now they have option means they can also go by what we are going to discuss for the other assessees, but they have an option that they can even go by the SLM method. For other assessees, there is only one method which is called as the block of asset method, and where compulsorily WDV approach has to be followed. We all know what is WDV. Now, power units also have this option that if they want, they can also adopt the WDV approach, and they have to select one of these options in the first year when they start their business. Thereafter, they cannot change the option in their lifetime. Fine? Okay. Now, in clause 2A, we have a new concept called as additional depreciation. What is this additional depreciation? So this depreciation, let us now call it as regular depreciation, which is allowed to all. This is, you can say, extra. Extra means regular plus this. That is why it is additional or extra, which is allowed only to some specified persons. Now, what are those specified persons? We'll study when we go in detail. So, for those persons who satisfy the conditions, regular they are getting depreciation, they will also get that extra depreciation called as additional depreciation. If you do not satisfy the conditions, you will only get the regular, which is allowed to all. So this is broadly the detailing of the section. Then there is some format, and then we are going to take up a practical example. But before I do this, let me give you a brief differentiation between what you have studied in accounts and what we are now going to do it in PGBP. Remember one thing, whatever I'm going to explain here is coming out of Rule 5. So Rule 5 has provided this different approach. Now, what is this different approach? In accounts, when you have done depreciation, if you remember, we used to calculate depreciation for each asset separately. So we used to have a separate account for each asset, and for each asset, we used to compute depreciation independently. However, that is not the case over here. Income tax says you have to make blocks. Blocks, or you can say groups. What is group? Similar assets will be clubbed and put in one block or group. Another similar assets would be clubbed together and put in another block. So in similar fashion, instead of having 100 asset accounts, I will have only 10 or 12 or 15 blocks, because each block would be having 10, 12, 15, 20 assets which are similar. I'll give you a simple example. In accounts, if you have multiple machineries in your business, which any big manufacturing company will have, accounts say you should prepare a separate account for each machinery and calculate depreciation separately. Correct? Income tax says no. Majority of the machines would fall in the same block, which is plant and machinery. And even though those are around 30 machines or 50 machines, for all you will make only one calculation, because we will club them. We will add them and make it only one category called as block of plant and machinery. You may have buildings at 10 different places. For the purpose of computing depreciation in income tax, we will calculate depreciation once for all the buildings combined. That will be called as block of building. So what income tax is doing, it is grouping the assets. Similar assets are put in one block. Now the question is, how will you come to know what all assets I have to club and make it one block? The answer is same asset, same rate will be one block. Now what do you mean by same asset? Now building and machinery cannot be same. So they are different. They will always be in different blocks. So same asset means all should be building, all should be machines, all should be motor car. Those things are called as same asset. Second, within buildings also, they have made category of residential and commercial. Because residential, they have given depreciation rate of 5%. Commercial, they have given depreciation rate of 10%. So within building, you'll have two blocks. Why? The buildings which are having 5% rate will go in one block. The buildings which are having 10% rate will go in the second block. Similarly, when you come to plant and machinery, within plant and machinery, they have made 3-4 blocks. So let me show you. The module, the blocks will be given. See. So these blocks income tax has created. So according to them, buildings would be broadly of either residential or other than residential. So buildings will have these two blocks. Then there are some particular specialized buildings which are for installing machinery and plant, etc., forming part of water supply. For that, there is a separate block. And then where you have temporary wooden structures, like at sites, they make site offices, that is also put in separate blocks. So within building, you have 4 blocks. Generally, this third and fourth block are not used much. But for furniture, you have multiple furniture items. You may have chairs, you may have tables, you may have sofas, you may have so many computer tables, so many almiras and all. Everything is put in one block only, because for furniture, there is only one block. Correct? Achha. Interestingly, it also includes all your electrical wiring, switches, etc. Then, for plant and machinery, they have made some 5-6 blocks. Again, in this, the most common block is this 15%, which is for motor cars, and for plant and machinery, this block, again 15%. Other than this, you have all very specialized plant and machineries. Then you have to remember for computers, including the softwares, you have another block. So computer will not be put in plant and machinery. It will be kept in a separate block. The rate is 40%. Similarly, for books, like for professionals, even for us, machinery and equipment is books also because we need them regularly for doing our profession. For that, the rate is 40%. So within plant and machinery, you have different blocks covering different specialized machines, but certain blocks are common, like all computer systems will be in one block and all remaining plant and machinery. Now, majorly, all businesses will have this 15% block only. Very few businesses will have the above blocks because they are very specialized machines, right? Then within ships, you have certain blocks. And most importantly, all your intangible assets, all types of patents, all copyrights, all trademarks, everything will be in one block. Now, this is what is the concept of block. So in your books, you may have 100 items of plant and machinery. Here, it may be only 3 or 4 blocks. You may have 15, 16, 20 buildings, some warehouses, some your office buildings, some your factory buildings, all will be put in one block of 10%. Then you'll have your workers' quarters or some flats or something for your directors. Again, all those buildings which are residential will be put in another block. So maybe in books of accounts, you may have 100 different items, which you may call as assets. Here, you may have hardly 5, 6, 7 blocks. So this is the first difference between our accounting concept of calculating depreciation and income tax. Income tax says we don't have time to calculate asset-wise depreciation. So group them and do calculation for the entire group. This group is the block. And all calculations up to the sale, that is up to the capital gain, because these are assets. Whenever you will sell it, the working will go in capital gain head. Even in the capital gain head, the working will be block wise. That is, you will not be calculating profit or loss of one asset sold. You will be calculating profit or loss of the entire block of assets sold. That we'll see when we proceed. Second very big striking difference is in our accounting depreciation. If you remember, whenever we purchase the asset, generally no asset is purchased on 1st April. Assets are purchased in between the year. We used to calculate depreciation proportionately. So if you have purchased some asset somewhere from 15th of May, you will count depreciation for 10.5 months. If you have purchased some asset, let us say on 15th of December, you will count depreciation for 3.5 months. So this is how we used to count depreciation. Many times, even in days, we used to proportionate the depreciation. I hope everybody remembers this 12th standard depreciation chapter. However, income tax says we do not get into so much of minute calculations. For us, either we will give you full depreciation or we will give you half. That's it. No doing proportion. No calculating depreciation month-wise or day-wise. All those detailed workings I don't want. Simply you take full or you take half. Now, how to determine on which assets depreciation will be half? For everything else, it will be full. For half, they have said that the year in which you have purchased the asset, don't see the purchase date, see the date of put to use. From that date till 31st March, that is the close of the year, if the days for which the asset is put to use comes to less than 180, then you take half. So what is the requirement? When you will take half? If in the year of purchase, the asset is put to use for less than 180 days. Now this will happen only in the first year. It will not happen later on. Only in the first year, that is in the year of purchase, this half depreciation is possible. Now, to determine this smoothly, I'll give you the cutoff date. The cutoff date is 2nd of October. So if your assets put to use, not purchase, put to use date is given after 2nd of October, any date after 2nd October, you should know that you will take half depreciation. Half means half of the rate. So if the rate is 10%, you will take 5. If the rate is 15%, you will take 7.5. If the rate is 40%, you'll take 20%. If your asset is put to use between 1st April to 2nd October, any date, you will take full depreciation. So this is what is again the second striking difference between your accounting and your PGBP depreciation workings. Third, interestingly, the year in which you sell the asset, again in the year of sale, we compute depreciation. How? From 1st April up to the date of sale, we count the number of days or months, and again we take depreciation for those days or months. Income tax says no depreciation for the asset sold. So you may have used the asset for some days or months and then you may have sold it. But again, see what you understand right from first point, that they don't make it asset wise, they make it block wise. They don't do it day wise. So they don't want to be so specific with the depreciation calculation. This may not sound to you very rational, but if you ask me, I find it very rational. It is very logical, very rational, right? And fourth most important difference is, if you remember, in accounts, we used to compute profit or loss of each asset separately, right? So in accounts, we used to calculate profit or loss of each asset sold. Income tax says now we have no identity of asset. We only know the block. We will calculate the capital gain. Here it is capital gain or capital loss, not for one asset, but for the entire block. Now, interestingly, that block may have 10 assets. You have sold one of them. No calculating profit or loss. We calculate profit or loss only when either you have sold the entire block or the WDV of the entire block becomes nil. So for one or two assets sold, we are not bothered for calculating capital gain or loss. We will calculate capital gain or loss, one, when all the assets in the block are sold, or two, when the WDV of the block becomes 0. How all this will happen, we will see when we go to the computation. Now, our financial year is 24-25. So, what is the format? Now, remember, we are doing computation of a block. Let us say this is block of plant and machinery having depreciation rate of 15%. So, what is the format? We take opening WDV of the block, entire block. Now, let us say the block has 10 machines and the total value of the 10 machines is 25 crores. So we'll take opening WDV as 25 crores. Now in this, we will add the actual cost of all those machines which are purchased during the year. So in the year, I have purchased 3 machines and the total value of all these 3 machines combined is 7 crores. So I will add it. Similarly, during the year, I may have sold some machines out of these opening machines which are now old, which are now obsolete. Let us say I have sold 5 machines at the total value of 10 CR. Simply I'll deduct this 10 CR. Now what is the position? 10 opening plus 3, 13 minus 5. So today I have 8 machines in this block as on the last date of my financial year. And the WDV of my block is 22 crores. Now, I will first check whether there will be capital gain or loss working or whether there will be depreciation working. Now, when capital gain loss working comes, when either you have sold the entire block, that is, you have sold all the assets, that is not the case. My block is still existing. Why? Because there are 8 machines. So all the assets are not sold. Or where the WDV of the block becomes 0. Is my WDV becoming 0? No. So when I have assets and WDV both, I will not compute capital gain or loss. In this year, there is no capital gain or loss, even though I have sold 5 machines. But in the year when either this becomes zero or this becomes zero, we will do working of capital gain or loss. Correct? Now, I know it may sound weird. It may sound कि sir logical नहीं है. But let me tell you, I find it very rational, very logical. And if I have to say something from your side as students, it is much, much easier, much faster than what you would be doing in accounts. Had it been accounts, you would have prepared 10 accounts for 10 machines and you would have done computation of each machine separately. You would have computed depreciation for all the 3 machines purchased and all the 5 machines sold separately day wise. And most importantly, you would have ended calculating profit or loss of all those 5 machines sold. Income tax is doing nothing. Now, since my block is having assets, my block is having WDV, it means my block is alive. We had a movie Tiger Zinda Hai. Similarly, here I will say block Zinda Hai. Block Zinda kab hai? Assets bhi hai, value bhi. And when block Zinda hai, you compute depreciation. And when you deduct this depreciation from the block, you will get the closing WDV. So I have 8 machines. After calculating and deducting the depreciation, whatever it comes to, my closing value comes to 16.5 crores. This 16.5 crore will again become opening WDV of the next year, and this process follows. Anybody having any questions up to this point? Please ask. Students, anybody having any questions up to this point? Please ask. धनुष, नॉर्मल एडिशनल डेप्रिसिएशन आई एम गोइंग टू एक्सप्लेन. मैंने अभी तक डेप्रिसिएशन कैसे कैलकुलेट करना वो नहीं बताया. विल कम टू द कैलकुलेशन. अदर देन हाउ टू कैलकुलेट डेप्रिसिएशन नॉर्मल एडिशनल, बाकी चीजों के बारे में इफ यू हैव एनी डाउट्स प्लीज आस्क. No questions? I thought you all would be having many questions. Wow. Yes, good question. Do we have to remember rates of depreciation given in module? Not all. In my sheet, I have given you the important block rates. That much you have to remember. Soumya, I'll explain on what you will calculate the this depreciation, additional and regular. I'll explain. Correct? No doubts? So, for additional only, Dhanush, but I've just said I'm explaining. Please give me some time. I am explaining now depreciation only. Be patient. Now, the first question is about additional depreciation, which is allowed under section 32, subsection 1, clause 2A. Most important point, this we saw even in the module. If you are opting for, not opting for, sorry, if you are under the default regime, which is the new scheme, which is now the default scheme, you do not get depreciation additional. You will only get regular. But if you are opting for the old scheme, then only you get additional depreciation. So this is one very important difference, that between old and new scheme, additional depreciation is one of the differentiating factor. Now, most important point, who will be given this additional depreciation? First condition, you should be a manufacturer. So trader, service provider is not eligible. Second, Additional depreciation is allowed only on plant and machinery block, not on building, not on motor car, not on any other block. Within plant and machinery also only if it is new and if it is not a second-hand plant and machine. And importantly, the plant and machinery should be one which is used in production. So let us say if you are bringing computers which are required for running your machines, you can take additional depreciation. But computers required in your office, not eligible. Similarly, cooling system which are installed in your production area because your production emits lot of heat. So to maintain the temperature, to cool down the temperature, you require cooling systems, that is eligible. But other than that, cooling system in your entire factory, in your entire office is not eligible. So this is also important that within machinery, it should be one which is used for production work. And most important, the rate of that machine should not be 100%. That is, the regular rate itself should not be 100, because if entire regular depreciation itself is 100, nothing is left to give you in addition. So these are the basic criteria conditions. So first, it is allowed only if you're a manufacturer. It is new. It will be allowed only for plant and machinery which is used for production, and the rate should not be 100%. Now, remember one thing, students, in the question, you have to first check whether the scheme is old or new. That is the method of computing the income is old or new. If it is new, then you will not take the additional depreciation in the answer. You will only take the normal depreciation. Only when it is the old scheme, you will take both. Second, if answer is required by both the methods, so you solve it by the old method, that is taking additional depreciation and regular, obviously. And when you want to find out the answer by the new scheme, you add back the additional depreciation in the PGBP profits, because in the new scheme, it is not allowed. Other way around, you first compute your PGP income as per the new scheme. When your computing is as per the new scheme, you will not take deduction of additional depreciation. And when after computing income or profit by the new scheme, now when you want to find out the profit as per old scheme, simply from the profit of new scheme, deduct the additional depreciation and other expenses also, which are different between the two. But here we are talking about additional depreciation. So that additional depreciation is the one of the differentiating factor between the old scheme and the new scheme. Okay. Now, if you have understood up to this point, let me take you ahead. Let me take you further to the calculation part. So now we all have understood who is allowed this additional depreciation. Now we see in this working, I have given that you claim normal depreciation, you claim additional. For claiming additional depreciation, you first check the eligibility criteria. Only then you claim additional depreciation, and also if you are in the old scheme. Otherwise, you will ignore additional depreciation. Right? Now, most important, whatever depreciation you are claiming, additional, regular, you are supposed to calculate the depreciation in two parts: half, full, half, full. Correct? Now, some very important points. Firstly, when you are computing these depreciation, normal depreciation is calculated on the WDV amount, and additional depreciation is calculated on the actual cost amount, because additional depreciation is allowed only on the assets which are purchased. So it is only allowed in the first year, because in the second year, the assets will become second hand. In short, additional depreciation cannot be claimed on opening WDV. So additional depreciation will be calculated only on the actual cost. Whereas normal depreciation is calculated on this WDV, which we have calculated, which includes opening plus purchase minus sale. So on this WDV, that is this value in my example, 22 crores, I will be calculating normal depreciation. And in this example on 7 crores, I will be calculating the additional depreciation. Correct? Now within normal, half full, within depreciation, half full, how to do it? That we understand when we take up an example. But before that, I'm going step by step so that everything is clear. So remember, in this example, normal depreciation is calculated on the WDV amount, that is 22 crores. Additional is calculated on the actual cost, that is 7 crores. Okay. We'll take a short break so that you have some mental relaxation, some break, and then we will start. Yes, Anubhav, I am giving the break. Don't worry. So around now it is 7:42. So we started 7:50. Fine. So these are independent examples. Messrs. Pushpa, a manufacturer, has provided details of its block for the financial year 24-25. All the figures are in lakhs. Now these are different cases. They are all independent. So opening WDV, you have 3 machines. 2 machines were purchased during the year and 2 machines out of the opening block were sold. Opening value of these 3 machines is 1000. This is same for all the cases. Then purchase value again is same for all the cases. Sale value I have changed to give the different impact. And one option is, in the last case, you have sold all the machines for this price. Correct? Now, both machines X and Y are purchased on 15th of May. In case A, that is the first case, both machines are put to use on the same date, that is on 15th May itself. However, in cases from B onwards, machine Y is put to use on 15th of October. So out of 2 machines, from B case onwards, machine Y is the half machine. Why half machine? Because it is put to use for less than 180 days. And how you know that? Because the date of put to use is after 3rd of October. Right? Now, by mistake, this case has also been called as B. Let me call it as capital B, just to distinguish so that you don't get a problem. Right? Now, I will solve this example so that you'll understand how depreciation is calculated and how it is different. So we are talking about block of plant and machinery, which is 15%. So in all cases, I've kept the other details same. So now see, in your actual sum, you will have different blocks. So it will be maybe block 1 building 5%, block 2 building 10%, block 3 maybe motor car 15%, then plant and machinery 15%, plant and machinery 40%, and so on. In your actual real life situation, maybe in exams also, but here I've taken only one block and I have curated different case scenarios so that you'll understand the difference between all these case scenarios, how the difference is created. So first is opening WDV, which is on 1st of April plus actual cost of assets purchased. This is total less. Now I'm using a technical word which is provided in the law. So for sale value, they are saying money is payable. So we use the same value. And now the difference is called as WDV under section 43 bracket 6. And this is on 31st of March 25. Fine. So it is 1200, 600, 650. So it is 1000. Now asset purchase is 200 and 600. So it is 800. Now just for your reference, remember here you have 3 machines. Here 2 machines are purchased. So my total becomes 5 machines and the cost is total of this block. Now up to this point, all the case scenarios are same. Now from here, the case scenarios change. Here 2 machines are sold for 650. I'm writing in bracket 2. So what is my situation? I have a WDV of 1150 with 3 machines in my block. Fine. Now, please pay attention, students. In case A, both these machines are put to use on 15th May only, that is before 2nd of October. So both the machines are put to use for more than 180 days and hence there is no machine which is for half depreciation. Correct? Now, less depreciation under section 32, rule 5. Now in this, firstly regular, within regular half, full. Then additional half, full. Correct? Now in the first case scenario A, there is no half. Why no half? Because both my new machines will be put to use on the same date of purchase, which is 15th of May. And since this date is before 2nd of October, so the put to use days would be more than 180 and hence both are eligible for full. In short, my entire WDV is eligible for full. There is nothing half. Now I'll just repeat one thing. Regular depreciation is calculated on the amount of WDV. Additional depreciation is calculated on the amount of cost. Now, we start with regular depreciation. I have to calculate the regular depreciation on the amount of WDV, which is 1150. The entire 1150 is eligible for full depreciation. So my depreciation would be this amount. 1150 into 15%. Nothing will come in additional depreciation half. Now, I will check whether additional depreciation is available. Yes, because you are a manufacturer. It is a plant and machinery. It is new. I'm assuming it is used in production and the rate is not 100%. Again, there is no half machinery. The machinery for additional depreciation is eligible for full rate. Most important, this additional depreciation is to be calculated on the actual cost, that is this 800, because it is allowed only once, because it has to be claimed on the new plant and machinery, which is only in the first year. Now, most important, the rate of additional depreciation is 20%. See, this 15% is the block rate, which is for regular depreciation. Additional depreciation has nothing to do with the block rate. It is always calculated at 20%. So this is how you compute depreciation in case A. And after deducting this, I will get my closing WDV. Anybody, any questions? Sir, we took 180 days because if we divide the year, yes, somewhat you can say so. Anubhav 172.5, which I think you are giving me the answer. So it is 115 and half of 115. Okay. So this is 172.5 and this will be 160. So you can subtract this and you will get the closing amount. But 100% means full rate of 20%. So as we saw in depreciation in income tax, either we take the half rate or we take the full rate. So when they are saying 100%, it means the full rate. Correct? Understood, na beta? Sir, MACHY is put to use on 15th October. Soumya beta, that is from case B onwards. Case A, both are put to use on 15th of May. Yes, Ishan. So I hope everybody understood case A. No doubts with case A with anyone. But 100% means I will give you full depreciation. Please don't mix between 100% is not the rate. First thing. Second thing, when they have put a condition that we will allow additional depreciation only when the regular rate of depreciation is not 100% means if your regular rate is 100%, then your entire cost will become depreciation regular only. How will I allow you additional? There will be no cost left to give you additional depreciation. So 100% condition means that your regular rate should not be 100, means it should be 15, 20, 40, anything, but not 100. If your regular rate itself is 100, let us say the block is plant and machinery 100%, then here itself you'll get the full depreciation of the cost. Where will there be any amount left to give you depreciation of additional? That is why the condition is that the rate of your plant and machinery block should not be 100, because if the block rate is 100, you will get the full cost as depreciation in the regular itself. I hope now it is clear to all. Priya is asking why 20%. So Priya, you tell me what should be the rate for additional. Beta, Tej, there is half depreciation in both. I have already written the format in that. For additional also I have written half. Only in case A, we are not finding the half because case A is so designed that there is no half. In entire income tax depreciation, whether it is regular or additional, you have half and full both. So that is also for additional. Please see the format which is there on your screen. Priya, you're saying why 20% for additional? So you give me a rate. You give me some rate. If you say why 20, then it means you have some other better option. Give me that option. Yes, beta. I'm waiting for your option. Give me some option then. Banipreet, you may continue. Anubhav, beta, you are supposed to subtract the depreciation to find out closing WDV. Okay. Anybody else having any questions or doubts? No? Let us proceed. Now, case B onwards, your second machine is put to use on 15th of October, which is less than 180 days. So now you'll have some interesting things coming your way. Firstly, in this case, the two machines which you have sold are sold for 800. So here I subtract 800. So my position is the WDV is 1000 and there are three machines. First check, block zinda hai kya? Because if block is there only, then there will be depreciation. And block zinda hai if there is asset and if there is WDV. So both things are there. You have three machines, you have 1000 WDV. So it means there is no calculation of capital gain. We will only do working of depreciation. Now comes the half and full. Firstly, my regular depreciation has to be calculated on WDV. So my regular depreciation has to be calculated on 1000. Please remember this. Out of 1000, one of the asset is half. Which asset is half? This asset Y is half. How much is the cost of Y? 600. So I have to claim depreciation on 1000. This is what is the rule, that the regular depreciation is to be calculated on your WDV. WDV is 1000. Out of this 1,600, which is the cost of that asset Y, is eligible only for half rate. What is my full rate? 15%. So half rate is 7.5. Now, how much I can claim for full depreciation? I could claim total depreciation on 1,000, out of which on 600, which is the Y machine, I could claim only half. So the balance 400, I will claim full. So here, this will be my working for half and full. So my full depreciation comes to 60, correct? And my half depreciation will come to 45. Please check. Raise your doubts, raise your queries where you have not understood something. Students, let me know your doubts and queries. If you have understood this, then maybe you will not have any problem in any of the further cases. No, beta, this question is not in the module. Module has a different question. I have created this question which covers all different case scenarios. Module will be having question on one of the case scenarios. Correct? Okay. Now, I'm eligible for additional. We are assuming we are going by the old method. That is why we are claiming additional. Sir, which plant and machinery purchase and sold should be considered for half and full depreciation? Dhanush, बेटा आपको sold machine का तो depreciation लेना ही नहीं. You have to only take depreciation of the machine purchased. So first see only the machines which are purchased. They are two, X and Y. Out of that, whichever machine is put to use after 2nd October, that is what is the half machine. That's it. Now in my example, out of X and Y, which one is put to use after 2nd of October? It is only Y machine. So for me, the half depreciation is of Y machine. Correct, Dhanush? Now, regular depreciation you calculated on WDV, that was 1,000. Additional depreciation you calculate on actual cost, which is 800. So now I have to make breakup of 800. In 800, there are two assets, X and Y, out of which Y is of 600, which will be in half. X is of 200, which will be in full. What is the rate for additional depreciation? It is 20%. So for X, which is full, I'll take full depreciation. For Y, which is half, I'll take half depreciation. So here it is 6. Here it is correct. Are you getting this? Students, is this clear? Whatever I have done. Yes, students, please let me know whether this is clear. If still something is not clear, please ask. Dhanush beta, why are you asking me to show the question? This is already uploaded. It is expected that you have it parallelly. If I keep on switching to questions, it may create confusion to other students. Do one thing, I'm switching to question. Please take a screenshot if you have not downloaded, so that you can switch to question whenever you have a doubt. So this is the question, beta. Please take a screenshot. ठीक है? Okay. Students, I'll repeat. I'm repeating in Hindi so that whoever is not very comfortable with English can understand this in Hindi also. So, इनकम टैक्स में डेप्रिसिएशन कैलकुलेट करने का ये एक अलग तरीका है, अलग फॉर्मेट है, जिसमें हम असेट को सेपरेटली कैलकुलेट नहीं करते डेप्रिसिएशन, ना ही कैपिटल गेन। हम असेट को ग्रुप बना के फिर उसका वर्किंग करते हैं। ये ग्रुप को हम ब्लॉक कहते हैं। इस एग्जांपल में द ग्रुप इज प्लांट एंड मशीनरी, जिसका रेट 15% है। एक ही ब्लॉक है और इसमें इतने सारे 5 अलग अलग केस सिनारियोज है। डिपेंडिंग अपॉन डिफरेंसेस, सब में कुछ ना कुछ मैंने डिफरेंस किया है, सो दैट जितने भी पॉसिबिलिटीज हो सकता है डेप्रिसिएशन में, सारे यहाँ पे कवर हो जा रहे हैं। अब इस केस में इफ आई एम एक्सप्लेनिंग यू केस बी, आपका ओपनिंग डब्ल्यूडीवी जो 3 मशीन थे उनका वैल्यू था 1000। आपने 2 नए मशीन खरीदे एक्स एंड वाई, 600 200 के, सो टोटल हो गया 800। आपके ब्लॉक का टोटल हो गया 1800। आपने इस साल 2 मशीन्स बेचे फ्रॉम योर ओपनिंग असेट्स, जो पुराने हो गए थे, वो आपने इस केस में बेचे फॉर 800। तो ये माइनस करने के बाद आपका जो डब्ल्यूडीवी बचता है दैट इज 1000। नाउ ये 1000 इज योर डब्ल्यूडीवी। अब प्लीज कुछ रूल्स याद रखिए। वो रूल्स हैं कि व्हेन यू आर कैलकुलेटिंग डेप्रिसिएशन अंडर दिस सेक्शन रेड विथ रूल 5, रेगुलर डेप्रिसिएशन आप डब्ल्यूडीवी के अमाउंट का कैलकुलेट करेंगे। एडिशनल डेप्रिसिएशन आप जो एक्चुअल कॉस्ट वाला अमाउंट है उसका कैलकुलेट करेंगे। अब इस बी केस में मेरा डब्ल्यूडीवी आया है 1000, सो मुझे यहाँ पे 1000 का रेगुलर डेप्रिसिएशन कैलकुलेट करना है और मेरा एक्चुअल कॉस्ट जो है वो 800 है, तो यहाँ पे एडिशनल डेप्रिसिएशन 800 का कैलकुलेट करना है। अब इसमें मेन चीज जो समझनी होती है वो है बाइफर्केशन ऑफ फुल एंड हाफ। तो इसमें आपको सिंपली याद रखना है, जो भी आपने असेट खरीदा है जिसका पुट टू यूज डेट 2 अक्टूबर के बाद का दिया है, वो असेट का वैल्यू आप हाफ में लिखेंगे और फिर जितना भी वैल्यू बचेगा वो आप फुल में लिखेंगे। अब इस एग्जांपल में मेरा वाई असेट जो है जिसका कॉस्ट 600 है, वो मैंने पुट टू यूज किया है ऑन 15 अक्टूबर, यानी 2 अक्टूबर के बाद, तो उसका मुझे हाफ क्लेम करना है। सो पहले जब मैं रेगुलर डेप्रिसिएशन ले रहा हूँ, इसमें जो मेरा वाई असेट है जिसका वैल्यू 600 है, मैंने वो 600 लिया और उसका डेप्रिसिएशन हाफ ले लिया। रेगुलर रेट इज द ब्लॉक रेट जो 15% है, तो उसका हाफ आएगा 7.5। अब मुझे टोटल 1000 यानी डब्ल्यूडीवी का क्लेम करना था, जिसमें से 600 मैंने ले लिया हाफ में, तो जो बचा है वैल्यू 400, वो आ जाएगा फुल रेट से डेप्रिसिएशन। ये हुआ रेगुलर का ऑन डब्ल्यूडीवी 1000 रुपीज। अब मुझे एडिशनल डेप्रिसिएशन कैलकुलेट करना है, जो मुझे लेना है कॉस्ट पे। कॉस्ट इज माई 800, जिसमें वापस जो हाफ वाला असेट है वाई, उसका कॉस्ट है 600, उस पर मैंने हाफ रेट लिया। जो दूसरा असेट है एक्स जिसका कॉस्ट 200 है, उस पर मैंने फुल रेट लिया। सो दिस इज हाउ आई कैलकुलेट डेप्रिसिएशन अंडर द इनकम टैक्स प्रोविजंस, एडिशनल, रेगुलर, फुल, हाफ। I hope it is clear to everyone now, the entire working of depreciation. ठीक है? Great. Now in my third case scenario, which is case B, capital B, I have sold the 2 machines for 1250. Now it will be more interesting. तेज बेटा, जब हम न्यू मशीनरी खरीदते हैं तो न्यू मशीनरी पे हाफ डेप्रिसिएशन ही आता है, ऐसा रूल नहीं है। अभी अभी मैंने एक्सप्लेन किया, न्यू मशीन में से जो भी असेट या जो भी मशीन आपने 2 अक्टूबर के बाद पुट टू यूज किया है, उसी का हाफ आएगा। अगर कोई नया मशीन जो आपने खरीदा है उसको आपने 2 अक्टूबर के पहले पुट टू यूज किया होगा, तो उस पे आपको पूरा डेप्रिसिएशन मिलेगा, उस पे हाफ नहीं आएगा. इज दिस क्लियर बेटा? Okay, going to this third case scenario where I have sold the two machines for 1250. अब यहाँ पे थोड़ा सा ट्रिकी होने वाला है हमारा गेम. So I have sold these two machines for 1250. Now the difference between this is 550. Now the rule is same. मुझे full और half करना है. My regular depreciation is to be calculated on WDV. WDV अब कितना बचा है? 550. मुझे जो हाफ डेप्रिसिएशन लेना है वो वाई मशीन का हाफ लेना है. वाई मशीन कॉस्ट इज 600. But if my WDV itself is 550, I can only take here 550. And there is nothing left for additional, क्योंकि मेरा पूरा WDV खत्म हो गया हाफ में. So in this case, I can claim only half depreciation, that also on 550, because I only have WDV left of 550. But when I go to calculate additional depreciation, additional is to be calculated on the amount of actual cost, which is 800 only. And in 800, 600 is Y asset, which is half rate. 200 is X asset, which is full rate. So my depreciation of additional will remain same. But because my regular depreciation is to be calculated on WDV, which is now only 550, I can claim not more than 550 depreciation. My new asset, which is Y, which is for half rate, is of 600. But since the WDV itself left is only 550, the maximum depreciation I can calculate here under regular is only on 550. So I have taken 550, for which I am using the half rate. This is the only technical part of the entire depreciation working where students get some confusion. Please check, see if you also have that some confusion. If it is there, please get it cleared. Yes, Dhanush, you're right. Ishan, there is no FIFO LIFO here. Here, you have sold the old machines which are part of opening. That is very logical. Practically, that will only happen. So there is no FIFO. Yes, Rajveer, the rule is you have to consider the half depreciation value first. So if I have any WDV left, the law says you have to treat it as WDV of the half depreciation. That is why I have taken the 550 for half. Yes, Asta, correct. Same point. We have to give priority to the one less than 180 asset. Dhanush, in that case, if you have sold the new asset itself, which you have purchased, then there is no question of depreciation on that. Because if the new asset itself is not there, because let us say I purchased this new machinery X and Y and I sold that machinery itself, how can you claim additional depreciation in that case? Because additional depreciation is only on the new assets, correct? I hope this is clear, beta. So I'm sure now everybody's queries are resolved relating to depreciation. So first case scenario, simple case scenario, there is no machine which is in half. In the next two, the machines are in half, but the difference is here in the case scenario, I got some amount in half, which is the value of Y, and the balance was for full. Here in this case scenario, I could not get the full value of Y also because my regular depreciation can be maximum on my WDV. And in this example, WDV is 550. Even though the cost of Y is 600, I cannot claim depreciation beyond 600. In fact, in this case, cannot be beyond 550 because my WDV left is only 550. Now, in these three case scenarios, there was no capital gain or loss. Why? Because block zinda hai. In next two case scenarios, you will get capital gain or loss working. You will not have depreciation working because the block will cease to exist. The block is going to end in the next two case scenarios. And if the block is going to end, there will be no working for depreciation. Harshada, do we need to give any case-wise conclusion? Harshada, please understand one thing. Question will be in one of these cases, means whatever question data would be given would be fitting in one of these cases. So whichever case is applicable to your question, you have to solve according to that. So if your case is of A, you'll solve like A. If it is of capital B, you'll solve like capital B, and so on. Fine, beta? Great. So let us proceed. Now, in this case scenario, you have sold two machines, but these machines, two machines are sold for 1950. Now, what will happen? If I have sold two machines, but for 1950, the problem is my WDV has become 0. And if WDV becomes 0, there is no depreciation. I cannot claim depreciation because if there is no value, how can there be depreciation? Because for computing depreciation, for deducting the depreciation, I need value. If there is no value, there is no question of depreciation itself. So whenever my WDV will become nil, I will not have depreciation in that case. So in that case, no working of depreciation, but there will be working of capital gains. Now I'm just showing you working of capital gains, though this will be dealt with in detail in the capital gains chapter. But just since it is related to our topic, let me show it to you here. So we are dealing with case C. Now, how do we compute capital gain? The format says first take the sale value, but the sale value is called as full value of consideration. In short, we call it as FVC. What is my full value of consideration? I have sold for 1950. Then they say subtract any expenses that you have incurred for selling or transferring these assets. If nothing is given, dash. This is called as my net consideration. From this, I will subtract the cost of acquisition, which in case of block of assets is as per section 50 bracket 1, 50 bracket 2. Now, what is this cost of acquisition? In case of block of assets, it is the total value of your block. So what is the total value of my block? 1800. So please understand, we are doing computation for the whole block. We are not doing it for independent asset. Had that been the case, I should have done in the first three cases also. But we don't do it for independent asset, we do it for the whole block. Right? Now the balance is my short-term capital gain. In this case, it is 150. Sir, we will not calculate normal as well as additional depreciation if purchased and sold in the same year, as we have to calculate depreciation not in year in which it is sold. Correct, Asta. Dhanush, sir, we have sold only opening plant. Why we don't take depreciation for purchased goods of 800 like previous case? Why we don't take depreciation for purchase goods? See, beta Dhanush, understand one thing. Depreciation is to be calculated on WDV. If your WDV is 0, no depreciation can come, neither regular nor additional. Why? Because whatever depreciation you calculate, even in accounts, you subtract it from the WDV balance to get the closing. If the WDV itself is gone, how can you claim depreciation? So we will not claim depreciation even of additional because my WDV is 0. That is what is the logical point. Last case scenario. Now, what has happened in last case scenario? You have sold all machines for 1450. So I have sold all machines. All the 5 machines which I was having, I have sold. Now, in this case, even though there is some WDV left, but my assets are 0 because I've sold all the assets. So practically, I will ignore the WDV again. Why? Because where there is no asset, there is no block left. So even though there can be some value left, but since the assets are 0, I will have to ignore the value. And again here, there will be no working of depreciation. And now again, I will go to the working of capital gain or loss. Now here my sale value is 1450. No expenses given. Again, my cost is 1800. Here I have a short-term capital loss of 350. So here it is short-term capital gain. Here it is short-term capital loss. Anubhav beta, WDV is 0, but there are 3 assets agreed. So you're talking about case C. Okay, so what should I do? Tell me. In case C, I agree that the WDV is 0, but there are 3 assets. Okay, I've written 3 assets. So what should I do better in case C different? Tell me. What different should I do in case C if there are 3 assets? I know there are 3 assets. Tell me what should I do different? Yes, correct. You're right. So students, this is how the entire working of the block, depreciation also, capital gain also is happening. Now, if you observe, actually the working is very easy because there are no technical points except that bifurcation between full and half. And that also, let me tell you, in your exam sums, you may not even get always the half assets, but even if it is given, I have given you all the possible case scenarios. Also, interestingly, the capital gain working, as you can see, is very, very easy. So even your capital gains chapter, though very lengthy in terms of the number of provisions, but the format of working is simple. You just have to put in the correct values. Is this clear to all? Understood, students? Excellent. So today we have completed one more major part, that is the depreciation working, which according to me is one of the most tricky workings. Why tricky? Not because it is difficult, because it is very different from what you study in accounts. And that is why many times looking at this does not appeal so much, because you somewhere find that it is not happening, it is not working. Why? Because you are very much accustomed to the accounting logic. Yes, Ishan, what you want to say, case C, tell me. Yes, Anubhav beta. Every subject has its own approach. Every subject is based on its own logic, its own principles, and we have to understand and appreciate all. Why would our remaining assets will be scrapped? Assets are always going to be useful. Why scrap? I did not get this point. You said remaining assets will be scrapped. Why? They are there in the block. Only the value is nil. Correct. You are using the assets. Yes, beta. Tej. Generally in exams, the block rates will be given. But still, as I said in my notes, I've given a list of the common blocks that are given in the exam. So at least those rates you should remember. But otherwise, in general, in exams, the block rates are given. It is not expected that you learn everything. Ishan, beta, if the value is nil, that doesn't mean that the asset is scrapped. The value is nil because mathematically, in this working, it is nil. Now tell me one more thing. In your books of accounts, whether it is nil, whether in your books of accounts, the value is nil. Exactly, then how can it be scrapped? This is only happening in income tax working. That does not make your asset scrap, no? Your asset, that machinery, in fact, that machine block is having two new machines X and Y that you are using for your day-to-day business. How it can be scrapped? Your business is running, no? Great. VAT will cover exactly under expenses. Such a what will cover exactly under expenses on transfer? Harshada, beta. Expenses on transfer. Now we're talking about capital gain, but we can just discuss for a minute. When you have to sell an asset, let us say like building, you appoint some agent who will get you the customer, you put some advertisement, you incur some expenses on its registration, on preparing the documents. All these are expenses on transfer. That is expenses required or incurred for selling that asset. Right, Beda? Okay. So students, that is all for today from my side. In the next lecture, we'll go again with the module, try to cover all the balance pointers left. Thank you very much for today. Please study the module thoroughly. I'm sure by now you all would have gained a lot of confidence, lot of control over this chapter, which is very important. Still, I will not expect, neither should you expect that you will become the master of this topic. In fact, professionals who are in practice for more than 20 years are still facing many challenges because there are many interpretations possible. There are different views on different provisions. So don't expect that you should understand everything in one go. It is a process. Even if you are able to understand the basic things, one or two things here and there are not clear, that is fine. Over a period, as you deal more with the subject, with the topic, it will get more and more clear. So there is a question, sir, when block is nil, still assets were in using, but when assets are nil, we have CG or CL. But when block is nil, in that case also you have CG or CL. Yes, Anubhav, correct. So when you are saying, Tej, that when block is nil, still assets were in using, but when assets are nil, we have CG or CL. But in both cases, when block is nil, that is WDV is nil, still you have CG or CL. And when all assets are sold, then also you have CG or CL. In fact, these are the two cases when you'll have CG or CL. When either all assets are sold or the WDV becomes nil. Fine. So that's it all. Thank you. Thank you very much. Thank you for staying there over time. And please study and be in touch with these subjects. Good night. Good night, Ashok ji. Take care. Yes, sir. Good night. Good night. Thank you all.